This video could save you over $10,000 on your taxes this year. These are 6 strategies that you could implement prior to December 31st that could save you that money. So if you've procrastinated like most other online business owners and now you're thinking, what can I do to lower my taxes prior to the tax time right around the corner? I've got 6 strategies for you that can absolutely help you do that. All right, I'm Mitch. I'm the CEO and founder of Strong Wealth, and we actually help business owners optimize their business and personal finances, helping them save on taxes, build wealth, manage their cash flow, and invest for their future. All right, so let's go ahead and jump into these 6 tax savings opportunities that you need to review prior to December 31st. Okay, so the time is running out to take advantage of these 6 strategies, so make sure that you watch this video and take action on it. Strategies 4 and 6 actually have the ability to save you over $10,000 on your taxes with them alone. Okay, so make sure that you watch all the way through and get all of the context and take this to your financial planner or CPA to make sure that you are saving the most amount of taxes you could in 2023. All right, let's go ahead and jump in. Strategy number 1. It's going to be 2 small strategies to start with, and then they progressively get bigger as we go in. So make sure, again, to watch all the way through. Okay, so accelerate expenses. What are your expenses you know you'll have to pay next year that you can effectively pull forward to this tax year? So if you think about, one example is software costs. If you have a monthly software cost, so you're on a monthly plan, you could go ahead and switch that to the annual plan. Pay for the whole next year up front. You'll probably save money overall over that long term, and you'll actually save on taxes this year by just prepaying that expense. Of course, if you have the money to do so. You could prepay your financial professional with tax time right around the corner. You're going to have to pay them anyways in Q1, so you could go ahead and prepay them early and just get the tax benefits this year. Also, if you think you'll need to buy any new equipment in Q1, just go ahead and do it now. These are just a few ideas, but if you want to think about, okay, what money am I going to spend early next year or over the course of next year that I know I'm going to have to spend anyways, that I could actually bring forward to the end of 2023 and get the tax benefits now. Okay, so only spend on necessary things that will actually help your business. I don't know why this is so hard to understand, but you don't actually get a dollar for dollar tax savings when you buy something that classifies as a business expense. Okay, so when you have a tax deduction, let's say you spend $100, all right, so it lowers your profit by $100 in your business. You only save the amount of money that is equal to your tax rate. So let's say your tax rate is 30%. You spent $100. You only save $30 on your taxes. So you still spent $70, cash outflow to, pay for that expense. So only spend money on things that you actually need and are going to help your business. Don't just go blow money on a bunch of different things that you don't need, because you're effectively still spending more than what you're saving by making those decisions. All right, strategy number 2, defer income or capital gains. Obviously, be careful with this one, but it is just something to think about. So you could push new client invoices to January 1st if possible. If you're thinking about selling appreciated stock or rental real estate or anything that could realize a capital gain, a large capital gain, maybe wait until Q1. It's only a few weeks away, and it will give you a full year of tax planning opportunities to work on offsetting the gain if possible. So if you're considering selling a lot of stock in order to maybe invest in something else, or sell a rental real estate property that will realize a lot of gains, capital gains for you, if you just wait until the beginning of January, that will give you a whole year until you actually have to pay taxes on that gain, and give you a lot of time to utilize other opportunities to offset that gain that you just realized. All right, so if you can push it off, it could be a good idea to do that, because if you go ahead and sell right now in December, you're going to turn around and owe the taxes here in just a few months. So if you just wait a few weeks, you could push that tax out quite a bit and give you time to take advantage of other opportunities. Just something to think about. All right, strategy number 3, tax loss harvesting. So do you have losses on stock or crypto? Okay, so you could go ahead and sell those securities, realize those losses before year end to offset any other gains that you've had throughout the year, or you could use up to 3K of that loss against your income. Okay, so something just to be careful of. If you're selling crypto, so Bitcoin or any other crypto, you can go ahead and buy it back immediately. So this is why it's such a cool strategy, because you can effectively continue to own the asset, but you get to take the tax losses, right now. So let's say that you bought Bitcoin 2 years ago. It's still down for you. It's coming back right now. But what you could do is just go ahead and sell it, realize those losses, buy it back immediately. So you effectively still own the asset. Nothing has really changed in your portfolio, but you get to take that loss and have it offset other gains within your portfolio this year. Okay, so this is a cool strategy that you should definitely try to implement, because it really doesn't hurt your situation at all, because you can continue to own the investment without any issues. So now stock, on the other hand, you have to wait 31 days to buy back that specific stock, so the IRS will allow that loss. Okay, so you could choose to purchase a different stock immediately after, and that loss will be just fine. But if you buy back the same exact stock or ETF, or something very similar, they may not allow you to take that loss on your taxes. So it's just something to be careful of if you're going to implement this tax loss harvesting strategy within your stock or ETF portfolio. Okay, quick example. Let's say you bought Apple stock and it has dropped $10,000. You also bought Google stock and it's up $10,000. You could sell them both and you have a net zero. Okay, so you won't pay any taxes on the Google stock gain of 10,000 because of the Apple stock loss of 10,000. Now, something that's important to realize is you could take these gains off of the table and offset the tax implications with this loss, but then you could go ahead and just reinvest that into some similar securities, not too similar so that the loss isn't allowed, but you could go ahead and just reinvest that into an asset that you expect to continue going up over the long term. And it's like you still own the same amount of assets, but you have now taken gains off of the table, and from a tax perspective, you're in a better position. Now, if you just realize the loss, that 3K could be deducted against your income, and the remaining 7K loss would actually carry forward to future years, which is pretty cool. All right, strategy number 4, optimizing QBI. Now, this is going to get a bit more complicated, so you want to make sure that you are consulting with your financial planner or CPA prior to implementing any of these next 3 strategies, because we just want to make sure that things are done correctly, and there could be other opportunity costs that you're missing out on, or other implications of using this strategy that causes issues elsewhere. So this is I'll get into it here and give you an example of what you can expect. But again, just make sure that you're working with a professional to take advantage of this correctly, so that you can save big on your taxes. I mean, just sneak peek here. Total tax savings, $20,000 in this quick example. So told you stick around for strategy number 4 and number 6 specifically. They can definitely pay off for you in the long run. All right. So now that your numbers are concrete for the year, run a tax projection. If your income is over 464, this is taxable income. I should just go ahead and put taxable income in here. Let's see. Taxable income is over 464,200 for married filing joint taxpayers, or over 232,100 for single taxpayers. Your owner's wages could be limiting your QBI deduction significantly, along with your 401k contribution eligibility. So I'll just be talking about the QBI deduction here, which is the qualified business income deduction that was brought into law by Trump back in 2017. That's the one I'm going to be talking about, but I will have another video up soon on how your wages within your business actually limit this deduction and your 401k contributions in more detail. So make sure to keep an eye out for that. Subscribe to the channel if you'd like to be notified. All right, so prior to year end, you could run a large payroll if your business allows it, meaning you have the cash on hand. Obviously, it's going to be hard to save money on your taxes if you have very little cash in your in your business. So if your business can afford it, then you can run a large payroll, and it could save you over $10,000 on your taxes. And here's how. All right, so this can be complicated, like I mentioned earlier. Plus, it does affect other deductions. So it's important to understand how this plays into the bigger picture. Okay, so consult with a professional. But anyways, here's a quick example of what I'm talking about and what the implications could be. So just a quick example here. John makes $750,000 profit from his business. It's taxed as an S corp. He chooses to only pay himself a salary of $80,000 in an attempt to save on self-employment taxes, which can be good for less profitable businesses. Okay, this amount of salary could be a great salary for a significantly less profitable business to save him on self-employment taxes. But here's where we run into issues. Because he makes so much profit, his QBI deduction, again, if taxable income is over these amounts, his QBI deduction in that case is limited to 50% of his salary, or $40,000. So he can only take a $40,000 a QBI deduction this year because his salary is so low. It's dependent on a couple other factors, but this is just what you need to know. And again, just take this to your financial professional and they'll be able to walk you through all the other variables that are applicable to your situation. But this is important to know if you're making good profit in your business. All right, so, but if he paid himself a salary of $210,000, his QBI deduction would be $105,000. That's $65,000 more in a tax deduction just from paying himself, $210,000 versus $80,000. Okay, so this is tax savings over $20,000 in your business. All right, this is a big difference, and this also does limit your 401k contribution eligibility, which I won't go into in this video, but it's also important to know. So this, you may pay a little bit more in self-employment taxes, those Social Security, Medicare taxes, because you're paying yourself a higher wage, but that would be offset by the additional QBI deduction, which would be $105,000 versus just $40,000 in the other scenario. So this is big tax savings opportunities, and if you're already set up as an S corp, this could be easily done with a tax projection and one payroll before year end. Boom, and you've just realized a ton of tax savings. All right, so something to watch out for if that is, if that's applicable to you. Strategy number 5: charitable giving and donor advised funds. So if you plan to give anyways to charity or your church, sneak it in prior to the year end for the tax benefits. So a donor advised fund, if you haven't heard of it, you can look it up, but it allows you to contribute, receive the deduction upon contribution. So as soon as you put it into this fund, you receive the deduction as if you gave it to charity, but you actually remain in control of when the assets go to the charity of your choice. So they can stay invested within this fund, and then you could distribute them out to charities over time, but you get the tax deduction up front as if you already did give it to charities in this year. So it's important to note that charitable giving will only lower your tax bill if you itemize your deductions. Okay, so if your itemized deductions are not pushing you over the standard deduction, which you can see down here, single and married filing joint or head of household, what those are, then giving won't actually save you on your taxes. But this is where a donor advised fund can actually be very useful, because you can stack your giving by contributing multiple years worth of contributions to a donor advised fund. So let's say you usually give $15,000 a year to charity, which doesn't push you over the standard deduction. But if you're like, well, I have the cash on hand to be able to contribute 3 years worth to this donor advised fund, $45,000, and I can then still give it to the charity over the 3 years, but I get the deduction now for the $45,000 as if I did give it to charity this year. So as long as you're over the standard deduction with your other itemized deductions and your charitable giving, it can benefit you on your taxes. Something to watch out for if you already plan to give or usually do that anyways. All right, strategy number 6 is a big one. Okay, so pass-through entity tax. This one is a unique one that you've probably never heard of. Financial planners and CPAs really aren't talking about this. So this is an uncommon strategy, I should say, that can save you big on your taxes if you live in a high tax state. So this is something to watch out for. And if you have questions, of course, reply in the comments below and I'll be happy to answer them. But if you live in live or do business in a high tax state like New York, California, Illinois, Hawaii. You probably know if you live in a high tax state because you hate seeing how much you had to pay every single year, and you have enough to itemize deductions, you could benefit from paying your state taxes through your business and receiving a deduction for them. Okay, so here are some common examples of itemized deductions: mortgage interest, charitable donations, state and local property taxes. I put up to $10K here, which is what I'm going to talk about here in just a moment. All right, so prior to 2018, the state and local tax deduction was unlimited, meaning the amount that you paid in state and local taxes could be deducted on your federal income taxes, and that amount was unlimited. But this 2017 Tax Cuts and Jobs Act actually limited that amount to $10,000 through the year 2025. All right, so as a result, many states actually passed some laws that allow you to work around this limit. So here's what you need to know in order to bypass that $10,000 limit and get your state taxes deducted from your business. All right, so the pass-through entity tax election allows entities taxed as partnerships or S-corps to elect to be taxed at the entity level for state income tax purposes. Single-member LLCs and sole proprietors are excluded, unfortunately. So this effectively allows you to pay your state and local taxes through your business, which lowers your business taxable income, which is huge. Okay, so here's an example, and you can see down here, potential total taxes saved is quite a bit. All right, so California, high income tax state, the PTE pass-through entity tax is 9.3% on the entity's net income. Okay, so if you elect to pay, if you do this pass-through entity tax election, you're paying 9.3% instead of the marginal income tax bracket that California has on their state taxpayers. All right, so this California business owner is making $750,000 in profit from his business, and here's what it looks like without the election and with the election. All right, so no PTE election, state tax owed equals $63,572. With this election, the state tax owed actually goes up about $6,000 to $69,750. Now you're probably wondering, why are you sharing this strategy as a way to lower taxes if it just goes up? Because it actually then lowers your federal taxes on the back end, and we need to look at the complete picture before making any decisions. All right, so no PT election, federal tax owed, $209,000. Oof. If you do this election, your federal tax owed drops to $182,419. So as you can see here, this is about a $27,000 tax savings federally that completely offset this $6,000 increase for a total taxes saved of $20,855. Okay, so this is quite a big opportunity to save on taxes if you're making a good profit in your business and you live in a high tax state. Now, this is something that you could get done prior to year end potentially. In certain states, there are limitations to when you can actually make this election, and there's a lot of other rules. So it's state by state, and you need to understand what the rules are for your state. So just reach out to your CPA, and they should be able to get you that information. And then you can know if you can get this done prior to year end, but you better move quickly and don't try to do this on your own. But those are the 6 strategies that you could implement prior to December 31st and save over $10,000 on your taxes this year. So if you've procrastinated, definitely look into these 6 strategies, and they can help you get some quick tax savings before year end. Okay, so one thing you're probably wondering is why I didn't mention pre-tax investment account contributions. Okay, the contribution deadline for these investment accounts is actually the tax filing deadline next April. So you can still contribute to those up until next April and receive the tax benefits for 2023, which is pretty cool because you can see exactly what your tax situation is going to look like and then make contributions to these accounts accordingly. So, you don't have to do these things prior to year end. I'll make another video here shortly in January, actually, showing you what strategies you could use after year end to still save on your 2023 taxes, which I'm sure will be helpful for a lot of us who are procrastinating and then get to next year and they're like, oh, I let my tax bill sneak up on me. Okay, don't let your tax bill sneak up on you. Make sure you have a tax plan and strategy throughout the year. If you do not have someone running tax projections for you on a regular basis, helping you understand what you can expect to owe and how to lower that, then you need to get a professional in your corner. If you're an online business owner or salesperson and you're looking for that help, we can help you. Just reach out. You can drop a comment below, or you could go to strongwealth.net, our website, and schedule a call with me, and I'll be happy to talk to you about how we can help you save on taxes and plan ahead so that this doesn't sneak up on you and you're not panicking this time next year. Okay, so just to summarize, here are the 6 tax opportunities to consider. Accelerate expenses, defer income and capital gains, tax loss harvesting, optimizing QBI, giving to charity through the donor advised fund, or pass through entity tax election. All right, if you have any questions, again, drop a comment. If this was your first video and you're not yet subscribed, please subscribe to the channel, because I want you to be notified of any other videos that I upload that could save you big on your taxes, or help you grow your portfolio, or just help you manage your finances better and have a plan going into 2024. All right, so thank you for watching all the way through, and I'll see you in the next